The market looks green, yet more people are losing jobs. Something doesn't add up, and today you'll hear why. Big tech valuations, a shaky labor market, and a market held up by a few giants. This is the kind of setup that turns a rally into a reckoning. By the end of this video, you'll know how to protect yourself before the music stops. Welcome to Money Studio, where we explain how money and technology shape your future. Let's cut through the noise and focus on what actually matters for your savings, your job, and your next investment move. First, let's talk about the illusion of safety. When a headline index makes new highs, a green index feels reassuring, but a green index can hide a red reality. On many days, the index rises because a handful of mega-cap names surge, while most other stocks quietly fall. That's a classic sign of narrow. Market breadth leadership gets thinner, risk gets fatter, and investors get complacent. If you only watch the scoreboard, you'll miss the play that matters. How many stocks are actually advancing versus declining? Second, consider concentration risk. When a small group of companies carries most of the index's weight, the market behaves like a single stock with extra steps. That can be fine until it isn't. If leadership stumbles, passive portfolios take the punch, even if you never touch those leaders directly. Think about pensions, 401ks, retirement trackers, and broad market ETFs. If the top names wobble, almost everyone feels it. Third, let's address the AI growth narrative. The story is powerful build capacity now, profits later. That's a familiar tech playbook, but it becomes fragile when expectations sprint faster than cash flow. Markets will tolerate capacity first for a while, then suddenly they demand profits and free cash flow. When those lines diverge too far for too long, enthusiasm can evaporate quickly. That is how a bubble doesn't deflate, it pops. Fourth, the labor market signal. You've probably heard terms like a freeze where companies neither hire nor fire. Yet many people are still seeing layoffs and rescinded offers, especially in layers of management and support. Whether or not the official data captures it, the signal is straightforward when businesses brace for uncertainty. They cut costs, protect margins, and postpone hiring. That's not the end of the world, but it is the end of easy mode. Fifth, volatility lives where valuation and reality disagree. When an index is pushed up by a narrow set of leaders, when profits lag the promises, and when households feel job insecurity, the gap between price and lived experience widens. Markets can live with a gap until a catalyst forces them to close it, and that closure rarely feels gentle. Now, let's get practical. What should a rational investor do in a market that looks strong on the surface but fragile underneath? First principle, survive first. Hold a cash buffer that covers 3 to 6 months of essential expenses. Cash buys you time, and time buys you options. If a job change or income gap hits, you don't want to be forced to sell assets on a bad day just to pay the bills. Second principle, diversify your return engines. A broad index fund can still be a solid core, but when leadership is extremely concentrated, add defensive sectors like utilities and staples to dampen drawdowns. You can pair beta broad exposure with ballast defensive exposure, so your portfolio isn't a one-trick pony. Third principle, upgrade quality. If you hold tech, tilt toward profitable, cash-rich names with clear unit economics and less reliance on perpetual funding. Momentum can reverse overnight, balance sheets don't. Fourth principle, respect correlations. In stress regimes, assets that used to zig, while others zagged, often zig together. Diversification still helps, but it's less magical than the brochure promises. That's why sizing and position limits matter. The goal isn't to own everything, the goal is to ensure no single thesis can sink you. Fifth principle, define your risk before you buy. Set maximum position sizes, decide when you'll trim, and write down your reasons in plain English. If you can't explain how an asset makes money, how it could lose you money, and what would make you change your mind, you're not investing. You're hoping. Let's map this to a simple, repeatable playbook. Step 1, liquidity. Top up your cash buffer to the level that lets you sleep. If that means pausing new investments for a month, do it. Sleep is alpha. Step 2, core exposure. Use a broad market ETF as the backbone. It keeps you participating without betting the farm on a single story. Step 3, defensive sleeve. Add a measured allocation to defensive sectors to smooth equity volatility. This isn't about timing crashes, it's about reducing the size of the punch. Step 4, quality growth. Own select tech or growth names where free cash flow is real, margins are durable, and dependence on external financing is lower. If the narrative cools, quality keeps your downside more manageable. Step 5. Alternatives and hedges. Consider a modest allocation to assets that diversify equity risk over a full cycle. If you include metals, size them prudently, and understand the tax and liquidity trade-offs, diversification works best when it's intentional and sized. Now, let's address careers because markets are only half the story. If you work in roles vulnerable to automation or middle-layer consolidation, make optionality your job. Learn the tools that are replacing repetitive tasks and position yourself to supervise, integrate, or monetize them. In every technology cycle, the people who move up the stack towards strategy, systems, and outcomes do better than those who stand still. If software is eating a task, learn to feed the software. Mindset matters. The market doesn't owe us clarity. But we don't need perfect foresight, only good habits executed consistently. Protect your downside, insist on quality, and refuse to chase heat you don't understand. That's how you compound through noisy cycles. Action checklist you can execute this week. Write your maximum position size per stock or fund. List your top 5 holdings, and one sentence on why each still deserves capital today. If you can't explain it, trim it. If you wouldn't buy it today, reduce it. Rebalance to restore your defensive sleeve. If leadership has run away from the rest, audit your skills, pick one automation tool, and apply it to a repetitive work task this month. Final word. Markets built on narrow leadership can keep rising until they can't. You don't need to predict the top, you need to plan for turbulence. Build cash, balance your exposures, and upgrade your quality. Whether the next move is a pause, a pullback, or a pop, you'll be positioned to keep what you've earned and buy when others are forced to sell. This is Money Studio. Subscribe, like, and turn on the bell for more daily insights on economy, investing, and current affairs. And if you want the deeper dive, check our full playlist on navigating late cycle risk with a calm professional playbook. See you in the next one.